Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq, coming to you live from Exchange in Miami. Joining me for this segment, we have Matt Cohen, Managing Director of Wealth Advisory Solutions with the U.S. Client Group at Principal Asset Management. He joins me to discuss an ETF that offers cost-effective exposure to high-quality mega-cap companies. Matt, it's great to have you with us. Welcome to Trade Talks.
Glad to be here, Jill. Thanks for having me.
You got it. Let's talk about the mega-cap space before we get into the ETF. What is Principal's assessment of this space as 2024 kicks off?
Yeah, absolutely. We as an organization still are leaning into the mega-cap space. We're actually overweighting the large-cap space. We think it's a really good place to be in part of a construction of a portfolio. Obviously, when you're looking at the mega-cap space, you're looking at the largest of the large companies. And our feeling is, if there is volatility, these companies tend to hold up very well. They've got a durable balance sheet. They've got well-known brands. And if you look historically over the last 3 decades, the mega-cap companies have provided some downside capture, but have also done well when the market's gone up. So it's really a good place to be, and it's a healthy part of a portfolio.
For investors that are reassessing their equity portfolios for this year, what are your suggestions?
Yeah, you know, we at Principal think as a construction of a portfolio, you should have a healthy dose of large cap in there. You should have a healthy dose of the U.S. Our feeling is the mega caps are an excellent place to be. A lot of people think mega caps are strictly the Magnificent Seven. They're not. We offer a product called the Principal U.S. Mega Cap ETF. Its ticker symbol is USMC. I like to say it's simple from a construction standpoint, but it's an elegant solution. Why? It's looking at the top half of the S&P 500 by market valuation. Today, that's 42 names. Okay, but we have an equal weighted chassis when we build the portfolio, and it's based on the building of this portfolio to get you a diversified solution. It's not just technology, it's a diversified solution. So when you look at these 42 names historically, as I said, they provide excellent downside capture as well as strong upside capture. But one thing we've noticed is when people are building portfolios, especially active large cap managers, they tend to stray from the mega caps. Why? They tend to hunt in what I'll call the 460 other names in the S&P 500. Why? They feel they can add alpha there. They feel, in some cases, the mega cap companies, while they're a big part of the market, they're in everybody's portfolio. But when in fact they're not, when you look at the Morningstar data on active large cap blend managers, on average 20% of their portfolios in mid cap names. And they have a really tough time beating the benchmark because of the stray. So when you're looking at portfolio construction, our belief is for 12 basis points, the US mega cap product, USMC, offers access to that large cap space, and in fact the mega cap space, but keeps you diversified and keeps you in large cap stylistically.
What would you say to investors who may want to increase their allocation to mega cap stocks, but they worry about the volatility, let's call it, in tech stocks, right?
Yeah.
That typically falls into this category. How would you advise them?
Yeah, I mean, 2 ways I would look at it. I would say USMC, it's 42 names, but it's about 30% technology. Well, maybe about 34% technology. A slight overweight to the S&P 500. When you look at the Magnificent Seven today, we have a 1% overweight on the overall portfolio. But it's a slight overweight. It's a 1% overweight or a 2% overweight in technology. It's a diversified solution. So when you look at these companies, it's not just technology. You're getting ample liquidity. You're getting, in our case, excellent balance sheets. And more importantly, as I said earlier, really strong brands. They tend to hold up over time, and it's not just technology is really the answer.
All right, Matt, appreciate the insight. Thanks for joining us on
Yeah.
Trade Talks. And thanks for joining me from Exchange. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.